From the Center for Agricultural Profitability at the University of Nebraska-Lincoln, this is Nebraska Farmcast, and I'm Ryan Evans. Today I'm joined by Anastasia Meyer, an agricultural economist with the Center for Agricultural Profitability, here to discuss her new article on estate planning, focusing on stepped-up tax basis and its role in the planning process. We'll delve into how this adjustment can help to reduce capital gains taxes for heirs and explore its implications for the transfer of farmland and other assets to the next generation. Hey, Anastasia, thanks for joining me.
Thank you for having me.
So if you can start just by explaining what stepped-up tax basis is, and then why it's important for family-owned farms.
So the stepped-up basis is a tax provision that allows the value of inherited assets to be adjusted to the fair market value at the time of the original owner's death. So this adjustment increases the assets basis, which is the value used to determine capital gains or losses when the asset is eventually sold by the heir. So this asset has to be inherited from one generation to another. It is especially useful for those family-owned farms that are looking at inheritance as a way to pass on land, stocks, other assets to the next generation. Now, I mentioned land, and that is going to be dependent on how that piece of land is titled. So if it is a joint tenancy, then the spouse would inherit it at a 50% stepped up basis. Otherwise, it's going to be how that piece of ground is entitled. As the average age of farmer and operator increases and a large portion of land is owned by either retired farmers or operators who farm that piece of ground that they own, I think we're going to be seeing a large transition of assets here in the future as they either are looking at estate planning and transitioning, or they pass away.
Yeah, that's a great point. And can you talk about how this stepped up basis can impact the actual calculations of capital gains tax for heirs who will inherit that farmland or other assets?
Yeah. By stepping up the basis to the asset's current market value, any appreciation that occurred during the original owner's lifetime is not subject to capital gains tax. So this reduces the tax liability significantly for whoever inherited those assets if they choose to sell those assets. Long-term capital gain taxes are taxed at a much lower rate relative to other types of income. And land and some other high value assets have a rapid appreciation over someone's lifetime, which makes it a concern for people looking to sell when they retire, or people inheriting the farm if they want to sell the ranch or farm or other assets. So the stepped up basis helps with those rapidly appreciating assets.
Yeah, and we encourage listeners to definitely check out your article. It's linked to in the description to this podcast if you're listening on a third-party platform out there. And it's also, of course, with the article on our website at cap.unl.edu. And in that article, you walk through a really great, simple example to illustrate this effect. Can you talk about that or maybe explain it right here on the podcast?
Yeah, I can talk about it. So in the article, I talked about a father, we called him Bob, and he bought land in the 1970s for $500 an acre. Very rarely can you ever find a piece of ground for $500 an acre, if ever. So let's say Bob made no improvements on the land, therefore no depreciation can be taken out on the land since land is a non-depreciable asset. If he went and put fences up, terraces up, buildings up, all of those could be depreciated, but land cannot be. If Bob was to sell the unimproved land for $7,000 an acre today, Bob would be subject to a capital gains tax of $6,500 an acre and taxed accordingly. Now, the tax rate is going to be dependent on how much income he makes and some other things. So I can't tell you exactly how much, but he is going to have that capital gains tax of $6,500 an acre at a certain tax break. However, if Bob doesn't sell the land and he wants to pass that piece of ground to the next generation, he could not sell it, hold on to it, and then the beneficiary would inherit the land at fair market value of $7,000 per acre on the day of his death. Then that basis is stepped up from $500, the original value that Bob paid for it, up to that $7,000 fair market value today. Now, if Bob's child or heirs decides to sell the land after inheriting it, they would be taxed on the sale amount above the $7,000 an acre. So let's say we are in a low farm economy year and land values actually go down a little bit, or they're not selling at $7,000 an acre anymore. If they sold less than $7,000 an acre, they could claim a capital loss on their tax return if the property is sold in an arm's length transaction. So what I mean by that is you can't sell the land to your friend at a reduced rate. It has to be a fair market, like on an auction, or there's specific guidelines with that arm's length transactions, but it can't be sold to a son at a reduced rate or other related party at a severely reduced rate. In order to receive a more favorable long-term capital gains tax rate, the heir has to own that piece of land or other assets for more than 1 year. Otherwise, they're going to be taxed at a higher rate for the capital gains tax.
In addition to land, you mentioned it a little bit before. What are some specific types of assets that would qualify for stepped-up basis? And then how can the heirs who inherit those go about documenting the fair market value at the time of inheritance?
Yeah. So current law not only supports a stepped up basis for grain, machinery, and land, but also prepaid assets on hand. So if you have stocks, those can be a stepped up basis. Grain, if you have an elevator or you have grain in the elevator or bin of grain that you inherit, that can be stepped up. And so maybe that's when we might see a loss on if you sell it. The machinery, livestock, it's all important to start documenting the values of those on the day of somebody's death. Now, that's a really difficult thing to do because as we grieve, that's not the first thing that is going to be popping in our head saying, hey, somebody I loved passed away. I'm inheriting stuff. What's the value of that tractor right now? But it is important to start collecting data as soon as you can on the values of these. Sometimes it's difficult to find the information for years after the fact. If you inherit land, I highly suggest that you have an appraisal done at the time the property is inherited to establish that new stepped up basis. For other investments such as stocks, machinery, keep those documents. If you turn in a balance sheet to the bank, keep those documents and other published market data in a file somewhere to establish those stepped up bases, especially if you are thinking that you will be selling land or those other assets or in the next few years if you don't have anybody to pass it on to.
And here in Nebraska, you write about how we're one of the just six states with an inheritance tax. So there's also this to worry about on top of stepped up basis and the provisions around that. So how do those two interact, and are there things that heirs should be aware of then, when they do inherit property in Nebraska, considering the inheritance tax?
Yep. So when Nebraskans inherit land or other property, they have to pay the inheritance tax to the county where that property is located. So the value of those assets need to be equal to what is on the inheritance tax return. So you shouldn't have a stepped up basis of $7,000 an acre, the fair market value, and then put on the inheritance tax return that it's only valued at $5,000 an acre. Those numbers need to be matching. I have been told by Tina Barrett from Nebraska Farm Business that, it all kind of depends on how the IRS is feeling. But if you cannot prove the basis, the IRS has the right to say it was zero. Now, for land, we can go through census and survey data. If you absolutely cannot find that piece of ground or those inheritance papers, that was filed with your counties. Let's say you inherited it back in the 1970s and now you're wanting to sell. You don't have anybody to transition it to. We can go through and help you kind of figure out what that value may be based off of census and survey values. But it's a lot easier if you have that documentation. Now, I will say if you are somebody who doesn't have anybody to pass land on to, we have also services such as LandLink that tries to match somebody who's wanting to retire to a new farmer who wants to come in and needs that help getting started. But that is a whole nother podcast to discuss.
Indeed. So what we always talk here at the Center for Ag Profitability when we're talking estate planning about creating a good team to do that process. And you mentioned this in the article as well. So what advice do you have for listeners when it comes to utilizing professionals for estate planning and how they can prepare to take advantage of the stepped up basis provision as part of that planning process and as part of assembling their team?
Yeah. So the first thing I always like to tell people to prepare is get an idea of what you want to do with your estate. Kind of either have those bulleted out or a list of what your goals are for your estate plan, transition plan. You need to have those done preferably before you go to your team with these ideas so that your tax accountant, your lawyer isn't just sitting across from you and, racking up the extra dollars when you could have done that at home. So I encourage you guys to think about this well in advance. If you are the younger generation and maybe you're thinking that the older generation should start thinking about this, just remember, you can't push a rope. You can't force this. This needs to have them be a part of it. This needs to be kind of their idea because you can't push a rope. You can't force this on anybody else. And then you need to utilize a whole estate planning team. So include an attorney, your accountant. Try to minimize those tax consequences or that you can have. Talk to your financial advisor or insurance advisors if you need to when developing that estate strategy. And I always like to say that you can shop around. If you go to an attorney, an accountant, financial advisor, whoever is involved in your estate planning team, and you feel like it's just not the right fit, it's okay to go to someone else. And it's okay to change these plans. I really suggest that families look at their estate plan, especially after big life occurrences. So if you had a marriage, a divorce, a new grandkid, a new kid, whatever the circumstances may be in life, it's okay to come back and readjust these estate plans. It's a lot harder to get that estate plan done the first time, and then it's easily changed from one circumstance to another if you decide to change it. But just the thought process of sitting down, thinking what you all own, what you need to think about in an estate plan, how to do that, what your goals are, is probably the hardest part. And then once you get to the process of going to that team, the hard part's done. Let them do their work, and then you can readjust it later if you need to.
Great information, Anastasia. I want to thank you for joining me and thank you for a great article, which again, listeners can find in the podcast notes and on our Center for Ag Profitability's website at cap.unl.edu. And of course, you'll find a host of great succession estate planning resources on that site as well. Thanks again, Anastasia.
Thank you, Ryan.
Nebraska Farmcast is a production of the Center for Agricultural Profitability at the University of Nebraska-Lincoln. For the latest research-based information and education resources to manage your farm or ranch operation, visit our website at cap.unl.edu. That's cap.unl.edu.